There is a pop-up appearing in millions of bank accounts right now. It is appearing on phones during lunch breaks, on laptops late at night, on tablets while people are trying to check a balance or pay a bill. The design is clean. The language is friendly. It says something like, "Help us serve you better. Please take a moment to update your annual income." The old figure is pre-filled in the box. Updating takes 11 seconds. The button says confirm. Most people confirm. They do it without pausing, without questioning, without any awareness that those 11 seconds just handed a financial institution the one piece of information it wanted most, not to serve them better, but to price them more precisely. Two customers at the same bank, identical credit scores, identical payment histories, identical spending patterns. One updated his income when the pop-up appeared 8 months ago. His income had grown from $74,000 to $96,000 over 3 years. The other customer has never updated her income since the original application 4 years ago. Today, he receives weekly calls from a relationship manager pitching wealth management services. His inbox is a rotating door of premium card offers with $480 annual fees. His credit limit was increased twice, without him asking, not as a reward, as an invitation to carry more balance. She receives standard account emails. Her experience is quiet. Her terms have not changed. The algorithm does not know what to do with her because the algorithm does not have enough fresh data to classify her as a target. Same bank, same credit profile, completely different customer experience. The only variable is 11 seconds and one updated number. My name is Zik, and what I want to talk about today is not a conspiracy. It is not a scheme. It is simply the mechanics of how banks use income data mechanics that are entirely real, entirely legal, and almost never explained to the customers whose financial lives they quietly shape. Start with the foundational fact that most people do not know, and that changes every subsequent decision in this conversation. Banks are not legally required to have your income information on file for most financial products. There is no federal regulation mandating that your credit card company know your current salary. There is no law requiring your bank to maintain updated income data on accounts you already hold. The periodic requests that populate your apps and your email are not compliance requirements. They are data acquisition campaigns dressed in the visual language of routine administration. This distinction is more important than it might initially appear. When something is legally required, you provide it, and that is the end of the conversation. When something is merely requested, when an institution wants information, it has no legal claim to. You have choices that the institution has deliberately made invisible by designing the request to look mandatory. Banks have spent considerable resources making income update requests feel like administrative obligations rather than optional data sharing with significant consequences. The form looks official. The language suggests necessity. The pre-filled field implies that updating is simply the natural completion of something already in progress. None of that is true. The request is voluntary, the consequences of declining are non-existent, and understanding what happens when you do provide that information is the reason declining is frequently the right choice. The first way banks use your income data is credit limit calibration, and it is more complicated than it looks from the outside. The surface logic is straightforward. Higher income suggests higher repayment capacity, so higher income justifies higher credit limits. This seems neutral or even beneficial. You earn more, you get more credit. That is how the system is supposed to work. Here is what the surface logic omits. Banks have decades of behavioral data showing that customers use more of the credit available to them than they consciously intend to. A customer with a $15,000 limit carries a higher average balance than the same customer with an $8,000 limit. Not because their spending changed dramatically, but because the mental availability of higher credit expands the threshold at which spending feels manageable. The bank is not extending your limit as recognition of your financial success. It is extending your limit because customers with more available credit generate more interest revenue, and the behavioral data shows this with enough consistency to build a business model around it. When you update your income upward, the algorithm recalculates your limit ceiling and typically increases your limit without any action on your part. Your spending environment expands, the bank's revenue potential grows with it. The framing that this serves your interests is technically available as an interpretation and practically misleading as a description of what is actually happening. The second way banks use your income data is what the industry calls ability to pay pricing, and this is the one that will genuinely irritate you if you have not encountered it before. The intuitive assumption is that higher income leads to better interest rates, lower risk, lower rate, higher earners get better terms. This assumption is directionally correct and strategically incomplete. Banks use income data not only to assess your likelihood of default, but to assess your price sensitivity specifically, your likelihood of noticing unfavorable terms and doing something about them. Research on banking customer behavior is consistent on this point. Higher income customers are statistically less likely to compare shop interest rates, less likely to call and negotiate, and less likely to switch institutions over a few percentage points. The cost-benefit calculation of rate shopping looks different when $300 of annual interest on a credit card represents a smaller fraction of your income. The bank's pricing algorithm knows this. It adjusts accordingly. A customer identified as high income and low sensitivity, someone whose income suggests they can afford worse terms and whose profile suggests they will not fight them, receives pricing that reflects that. Combination, not as punishment, as optimization. The bank is not penalizing your success. It is charging what the model predicts you will accept without resistance. Your income update is the data point that tells the algorithm how much resistance to expect. Keeping that information absent or outdated removes one of the primary inputs into a calculation that is not operating in your favor. The third way banks use your income is marketing segmentation, and this one is the most immediately visible in daily life once you know what you are looking at. The moment your income updates in the system, your marketing profile recategorizes, the offers that appear in your banking app change, the emails shift in frequency and product type, the calls from relationship managers increase. High-income customers become targets for premium cards with substantial annual fees, personal loan products framed as financial planning tools, investment services, and insurance packages all calibrated to the income bracket the algorithm just placed you in. Banks maintain detailed models of expected revenue per customer at each income level. They know that a customer who just updated to $100,000 is statistically more likely to say yes to a $420 annual fee card than a customer whose file shows $65,000. They know that income growth signals financial complexity, which signals more products that can be sold. They know that once a customer holds multiple products with an institution, the switching costs rise and retention becomes passive. Your updated income does not sit inertly in a database. It activates a revenue extraction sequence calibrated to your specific earning level. The pop-up that asked you to update your information was the first step in a process you were not told you were entering. The fourth way income data works against you is the one most people never think about at all: its role in algorithmic decisions during economic stress. When markets weaken and banks review their portfolios, automated systems make rapid decisions about which accounts to protect and which to shed. Credit limits get reduced. Interest rates on existing balances get adjusted upward. Accounts get proactively closed. These decisions process thousands of accounts simultaneously through algorithms, and income data is among the most heavily weighted variables. The outcome is not predictable in a simple direction. A recently updated high income can work for you. The model sees continued repayment capacity and maintains your account favorably, or it can work against you. The ability to pay pricing logic kicks in and the bank increases your rate because the model predicts you can afford worse terms and will not leave. A customer with outdated or absent income data gets evaluated primarily on behavioral signals, payment consistency, utilization patterns, account longevity. Behavioral data reflects what you actually do. It is harder for a bank to weaponize than stated income because it is observable rather than claimed. And if your behavior is good, good behavior tends to produce consistently good treatment. The less fresh income data the algorithm has, the more it must rely on your actual financial conduct to make decisions about you. If your actual financial conduct is responsible, this is almost always the better evaluation basis. If this is showing you a dynamic in your banking relationships that was always operating but never visible, take 2 seconds and hit the like button. It genuinely helps the channel, and I appreciate everyone. Now, the questions the mechanics raise. When are you actually required to disclose income? When is it optional? And when does providing it serve your interests rather than theirs? Mortgage applications require full income verification under federal qualified mortgage regulations. You will provide pay stubs, tax returns, and employment documentation. This requirement is not negotiable, and the verification exists for legitimate reasons that protect both borrowers and the housing market. Provide everything required completely and accurately. Auto loans through most lenders require income disclosure with varying verification standards. The necessity depends on lender type and loan amount. This is generally not optional in any meaningful sense. Credit card applications request income, but here is the structural fact that reveals how banks actually use this data. Credit card companies generally cannot and do not verify the income you provide. They have no access to your tax returns without explicit permission. They cannot see your pay stubs. They rely entirely on what you tell them. If income data were primarily a risk management tool, if its purpose were genuinely to assess your ability to repay banks, would verify it? They do not. They collect it without verification because the value they extract from it is in the profiling and pricing applications described above, not in credit risk assessment. That is what the absence of verification tells you about the actual purpose of the collection. Periodic income update requests on existing accounts are entirely voluntary with no exceptions. No legal requirement, no regulatory basis, no account consequences for declining. The pop-up is engineered to create the psychological experience of obligation. That experience is manufactured. Close it. When it reappears in 3 months, close it again. Your accounts will function normally, your credit score will not change. The only thing that will not happen is the bank getting the fresh data it wanted to recategorize you. One important line that must be stated clearly: none of this is an argument for misrepresenting your income. Providing false information on a credit application is fraud. It is illegal and carries consequences that no short-term benefit justifies. The strategy here is not misrepresentation. It is the entirely legitimate decision to decline sharing information you are not legally required to share, a decision that is available to you and that the bank would prefer you not know you have. Here is the tactical framework organized by situation. For new credit card applications, provide income information because it is functionally required for the approval decision. Be thoughtful about what you include if your income has multiple components or significant variability. Report accurately, but do not interpret broadly. You are not required to volunteer for every income source. Report what is accurate and material and nothing beyond that. For income update requests on existing accounts, close them without responding unless you have a specific personal objective that requires income disclosure to achieve. There is no penalty for indefinite non-response. The requests will cycle. Close each one. After several months of non-response, the algorithm's income data on you goes stale and your profile receives less targeted treatment. For credit limit increases you are being offered without requesting, evaluate whether you actually want the increase before you provide the income data required to process it. If your current limit meets your needs and you maintain low utilization comfortably, declining the increase preserves both your data privacy and your utilization ratio. An unsolicited limit increase is not a gift. It is an invitation to carry more balance, accompanied by a request for the data that enables more precise pricing of that balance. For any loan application where income verification is legitimately required, provide exactly what is required and ask specifically what additional documentation is needed before providing anything beyond the explicit requirement. The question clarifies what is necessary versus what is simply being requested opportunistically within the application process. For phone calls requesting income updates, you can decline directly and briefly. The call will end. Your account will remain open. The representative is following a script designed to create urgency and compliance. You are not obligated to follow the script's expected outcome. My contractor friend learned this the hard way. Variable income, some months at $8,000, others at $14,000, depending on project load. She had maintained a peaceful, low friction banking relationship for 2 years. Then a credit limit increase offer arrived, and the bank asked her to update her income to process it. She entered her current earnings significantly higher than her original application. Within 60 days, everything changed. Daily calls, premium product pitches, balance transfer offers arriving by mail. Her inbox became a persistent marketing campaign she had not signed up for and could not easily exit. She stopped updating her income entirely after that, closed every subsequent pop-up without responding. 6 months later, her banking experience had returned to quiet. The algorithm's fresh data had aged into irrelevance, and she had been recategorized back toward default treatment by the simple absence of information she had been feeding it. The bank did not punish her for going quiet. It simply lost the signal it needed to keep the targeting active. Stale data produces standard treatment. Fresh data produces optimized extraction. Every time you update your income, you reset the clock on a targeting cycle that runs without your awareness or consent until the data ages out again. There is a deeper principle underneath all of this that extends well beyond banking. Every institution that requests your data is collecting it in service of its own objectives, not yours. The framing serving you better, improving your experience, ensuring accuracy, describes the presentation of the collection, not its purpose. The purpose is enabling more precise extraction of value from the relationship. Understanding this does not require cynicism about institutions that provide genuinely valuable services. It requires accurate awareness of how the relationship functions beneath the surface of the customer experience that has been designed to obscure that function. Banks are not adversaries. They are rational, profit-maximizing entities that treat customer data as a productive resource. They will collect every piece of data they can access and use it in every way that generates revenue. That is not a moral failing. It is the operating logic of the business. Your response to that logic is not anger. It is a strategy. Provide what is legally required. Decline what is voluntarily requested. Let your behavior speak in the data points they can observe rather than the data points they are asking you to hand over. I'm Zik. The pop-up is going to appear again, probably soon. Now you know exactly what it is, what it triggers, and what closing it without responding actually means for the relationship you have with the institution asking. It means you are paying attention. And institutions that profit from inattention are not well served by customers who have learned to read the fine print beneath the friendly interface. If these conversations are consistently giving you something worth having, subscribe. Every week, one more layer of the financial system is explained in terms you can actually use. The next one drops soon. Make sure you are there. Thanks for listening. I'll see you in the next video.